In 2025, imagine you have just $1,000. The big question is, where should you put that money to get the best results? Many beginners ask, where do I start without risking everything? Nearly 60% of new investors lose money in their first year because they don't plan well. Whether you're saving for a new home, retirement, or just building a safety net, every dollar truly counts. What if you had a simple, step-by-step plan that fits your comfort with risk? Picture your $1,000 growing steadily, whether you want a safe, moderate, or aggressive approach. If you're new to investing or want smarter options in 2025, this video is made for you. In just a few minutes, you'll get clear, easy steps for conservative, moderate, and aggressive investing. Let's make your first $1,000 investment with confidence, no matter your risk level. So why is $1,000 the perfect amount to start investing? In 2025, the world faces inflation and market shifts that make small, steady investments powerful. Many beginners feel overwhelmed starting small, thinking it's not enough. But here's the truth. Studies show consistent $1,000 investments often beat sporadic big deposits over time. Real people have turned just $1,000 into real wealth by being patient and smart. This year is special. New tech growth and economic changes create opportunities you won't want to miss. Some fear losing their $1,000, while others risk missing out on big growth. Even Warren Buffett started with small sums. So, what's the safest way to invest your $1,000 in 2025? Let's find out. If you want to start safe, conservative investing is the way to protect your money and still see growth. This means putting your $1,000 into low-risk options like bonds, high-yield savings accounts, and broad index funds. For beginners who don't like big risks, this brings peace of mind, knowing your money is secure. Historically, bonds give around 3 to 5% returns each year, with very little chance of losing your initial investment. Many retirees and cautious investors rely on this steady approach. Even conservative portfolios can beat inflation if balanced well. But there's a question. Will this slow but steady growth be enough to build real wealth? It's a classic trade-off, safety versus growth. Some bonds now offer tax benefits. So, if conservative is safe but slow, what's a smart middle ground? If you want a mix of growth and safety, moderate investing might be your best choice. This means combining stocks and bonds, using tools like ETFs, diversified stock portfolios, and some fixed income. For many, it's about growing money steadily without losing sleep over market ups and downs. On average, moderate portfolios earn about 7 to 8% returns yearly over decades. Young professionals saving for a house or family often choose this balanced path. Moderate risk means you may face temporary losses during market drops, but history shows the market usually recovers over time. The real test is staying calm when markets crash. It's a battle of risk tolerance versus reward. Using dollar-cost averaging helps reduce the risk of bad timing. But what if you want to be bold and aim for big gains? If you're chasing big growth fast, aggressive investing might fit you. This means putting money into stocks, cryptocurrencies, and emerging tech with high volatility but the chance for huge returns. It's perfect for thrill seekers and young investors who have time to recover from losses. Some cryptocurrencies gained over 1,000% in a year, but the risk of crashing is very high. Think of early investors in Tesla, Bitcoin, or AI startups who made big gains. But aggressive investing demands discipline and clear exit strategies. One wrong move could wipe out all your gains. It's a constant battle between fear of missing out and fear of losing everything. Some aggressive funds require less than $1,000 to start. So, how do you decide which risk level suits you best? Before investing, it's important to know your risk profile, how much risk you can really handle. This depends on your age, income, goals, and emotional readiness. Many beginners think they can take big risks, but panic and sell when markets drop. About 70% of investors lose money because of emotional decisions. There are plenty of stories about people who had to change their plans after costly mistakes. Your risk profile isn't fixed. It can change as life changes. Checking in regularly is key. Picking the wrong risk level can cause stress and big losses. It's a fight between discipline and impulse. Many investing apps have quizzes to help you find your perfect risk profile. So, once you know your profile, how do you build your portfolio? Starting with $1,000 means taking smart, practical steps to build your portfolio. First, open a brokerage account, use a robo-advisor, or try beginner-friendly apps like Robinhood, Fidelity, or Acorns. Many platforms now offer zero-commission trades, so you keep more of your money, a big plus. Some allow buying fractional shares, which means you can invest in expensive stocks even with small amounts. Feeling in control and confident, even with little money, is a big step forward. Watch out for fees and common beginner traps, like frequent trading or hidden costs. It's about balancing convenience and cost. Automatic reinvestment helps your money grow faster over time. So, what common mistakes should you avoid when investing your first $1,000? Many beginners fall into traps like chasing hot stocks or panic selling when the market moves. Patience often beats the rush for quick wins. Fear and greed are the biggest enemies in investing. Did you know about 80% of trading volume is speculative, not true investing? There are countless stories of new investors losing money trying to follow the latest trends. Even experts make mistakes. Investing is a constant learning journey. The problem? These errors can cost you years of growth and hard-earned money. It's a constant battle between impulse and a well-thought-out plan. If you invest $1,000 with an average 8% return, it can grow to over $21,000 in 30 years. The biggest risk? Doing nothing and letting time pass. Starting late means you have to be smarter and invest faster, but it's never too late. Many millionaires began their journey with just $1,000. So, with this knowledge, what will your very first step be right now? The real lesson? Small beginnings, combined with steady, consistent effort, lead to true financial freedom over time. That $1,000 isn't just money. It's your launchpad for building wealth in 2025 and for many years ahead. The true secret isn't a magic formula. It's knowing your risk, being patient, and always learning more. Start now, and your future self will thank you. Investing doesn't have to be confusing or scary, no matter how small your first amount is. Today, you've learned a clear and simple plan to grow your money safely and smartly. If you want more easy-to-follow investing guides, don't forget to subscribe and hit the bell to stay updated. Now tell me, what's your risk style? Are you conservative, moderate, or aggressive? Drop your answer in the comments below. I'd love to hear.